Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in. And if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi, everyone, and welcome to a milestone episode of the Capital Mind podcast. This is episode number 25. We've been doing this for just over a year now, and it's really been lots of fun. And while I wish we were doing this under less stressful and difficult times, but today's episode promises to be fairly interesting. So, just to get us started, I'm Shrey Chandra, and I'm here with my colleagues Vashish Iyer and, of course, Deepak Shenoy. And we're here to discuss what has really been one hell of a week. So, Deepak, what just happened? Yes Bank failed, and that feels like it was a lifetime ago. Fintech startups, some very big names, were out for a couple of days. The coronavirus has started gaining traction even in India. Oil prices fell by a third, and then the stock markets collapsed dramatically, with the Nifty hitting a lower circuit and then finally rebounding late on Friday afternoon. I think we've aged years in a week. So can you help us put this in perspective? What's really going on?
Yeah, it's a brilliant question, Shrey. I think the Chinese curse, as it is all, we're living in interesting times, more interesting than we wanted, but that's how it is. And the three things that seem to have impacted us the most, and you've mentioned them, there's the coronavirus, which we don't really know the impact of today because we only know in bits and pieces about how crazy it was in China, how crazy it is in Italy and Iran right now, how crazy it's likely to be in the US, having announced an emergency about it, and how India is also reacting to it, which is by cancelling all visas of foreign nationals, by tracing every single individual that's come in and tracking how they're doing in terms of quarantines, in terms of isolations. The panic that seems to be ensuing is actually going to cause a lot more damage than perhaps the disease itself. I'm not saying that the disease is not killer, but it is definitely not as, it spreads a lot. And by definition, something that spreads a lot but doesn't kill too much is actually a pandemic. It's something that can really, really cause pandemonium. That panic itself is causing a lot of fear in the economic markets. So you have the fear of shutdowns, businesses shutting down, lockdowns. So you can't leave cities, you can't leave territories. Businesses not allowed to function because they involve people gathering, like restaurants, pubs, bars, and parks, sports facilities and clubs. So you have all of these things causing further layers of panic, and that's what's also brought the stock market to an extreme. Add to that the Indian layer of things with Yes Bank. So Yes Bank, being a scheduled commercial bank, 300,000 crores in loans, roughly. They have a huge balance sheet. This is was the fourth largest private bank, probably the fifth even now. Had to set up a moratorium last week. Spooked a lot of depositors who couldn't take their money out because until the moratorium is lifted, which will be next week, as we found out yesterday, for this time, they won't be able to touch their money. This causes payment crisis of integrated partners like the startups you mentioned. And also, of course, the fear is that people now no longer trust private banks in a certain way. And then they start saying, as soon as the moratorium is lifted, I'm going to move my money to a public sector bank. They start moving their deposits from other banks to public sector banks just because they're afraid. So this causes another layer of panic. And you can see parallels because the way the reaction is with the coronavirus, where you said, okay, we have to panic early. We have to stop people from meeting. So we're going to set up the rules that don't allow people to meet and therefore slow down the spread. Similar way, Yes Bank moratoriums work in the sense that they say, we won't allow you to withdraw deposits more than 50,000 rupees until we've sorted out this mess. And when we've sorted it out, we hope that the exit of depositors will be slow rather than all sudden, which would cause a crisis. The third thing that's added to this mix and perhaps is related is that the fight about shale oil and crude oil between America and Russia and Saudi in a way, where Russia refused to cut production of crude. And Saudi said, listen, I'm not going to be the only one cutting. And Saudi decided to actually increase production. And this has resulted in a massive drop in crude prices from the 50s or 40s, late 40s, early 50s to as much as $31 a barrel. This massive reduction causes, perhaps in the short term, credit freezes in the US, because a lot of these are financed through junk bonds or what is called the high yield market. The high yield market is frozen. And in order to now ease that, we've had a lot of regulatory action. And none of that is actually soothing markets' nerves right now because everybody's in panic mode, but it's probably going to help in the longer term. Some of those include rate cuts. So America has cut rates by 50 basis points. Canada has cut rates. England has cut rates. Australia has cut rates. ECB has promised to add more money because they're already in negative 0.2%. They have no idea how to cut from there. And you've got a bunch of regulatory measures as well, fiscal measures as well. From the US, you're going to get a bit of stimulus. From the US, you're also getting a $1.5 trillion QE. That's dwarfs, like, I think the first two QEs put together, or perhaps all of them. But we're getting all of that literally on 1 or 2 days just to be able to calm markets down. Yet markets have been down tremendously, and surprisingly, when the US announced an emergency yesterday, the US markets went limit up. So it's been a very interesting week, and in all probability, this is not the end, because we're going to see a lot more of this. The coronavirus is just getting started. Like Vashish told me earlier today, we had 100,000 cases last week. Today we're at 150, and India hasn't even gotten started. So I think there's a lot more to come, but this is probably what they say the prelude, the opening act of what is going to be an interesting 2 months.
All right. So when I look at it, thinking of the stock market collapse that happened on Thursday and a bit on Friday before the recovery, there's this famous quote which is obviously attributed to Warren Buffett, where they say, be greedy when others are fearful and fearful when others are greedy. Well, my experience was pretty weird on Friday, where everyone I met kept asking me, are you buying, or is now the right time to buy? And that's extended all the way to today on WhatsApp messages, emails, and the like. So do I just know a lot of contrarian people, or what's the deal here? Do you think now is really the time when you should be piling in, or what do you make of the situation?
So, Shreya, the worst part about experiences, you end up being more cynical than you should be, perhaps. But one of the problems that you have if you've been through like a 2008 style disastrous collapse is that that the first fall isn't the final fall. We're really at 20% away from the peak. And let's try to put that in analysis from two levels, okay, quantitative and qualitative. So right now, in the last 3 months, foreign investors have taken out 39,000 crores, out of which 25,000 crores in equity alone. And 39,000 crores is more money than they put in the first 2 months. So literally just March is offset whatever they put in Jan and Feb.
Does it seem like it's just the FIs who are being afraid? Everybody else seems to be greedy.
Yes, it does. In fact,
we had the highest inflows in MFs in February, right?
Yeah, we had
Very
about
high
8,000 more crores in February. So it seems like people are greedy when
and domestic institutions are matching all the things that FIs are selling.
Yes, in literally yesterday, I think there was a 6,000 crore sell by FIs and a 5,800
amount
by domestic investors. So in a way, institutions seem to be negating each other out. And the retail, some of retail is panicking, some of the retail is putting in money. So,
have you seen, like in our own community, and as Shrey was saying, everybody seems to be ki kya kharide? What should we buy? Yes. Give us ideas. And even Twitter seems to be, boss, bottom is done. Let's buy. This is the great time to buy. If you've been waiting for 2008, don't wait anymore. This is what you have been waiting for.
Yeah, so I think one of the things that, if you get to a point of understanding of where things are, you got to balance this out with a little bit of subjectiveness and a little bit of objectiveness. Let's look at the objectiveness part. Let's look at the past history and say, would this be the time to literally sell your neighbor's house and buy everything? The answer has been in the past. A 20% fall hasn't really been indicative of in such a short time, has really never been indicative of the amount of time it takes to form a bottom. From 2000, we calculated about 12 such times when the market has fallen more than 20%. And then from that point has recovered 20%. So actually we fell about 30% now, and we just, it was a lower circuit, and then the market closed down 20% from the peak.
Yeah, the 30% was just for like 10 minutes.
Yeah. So I won't take that as too much, but assuming that, we were to track this, we've seen a number of days. So for instance, in 2001, 2002, you had a 218-day process of bottoming out. That means it took 218 days from top to bottom, and the bottom was roughly 41% below the top. In 2010-11, there was a 29% fall from the top to the bottom. It took 414 days. So like this, you tabulate all of them. The fastest fall was in 2006. It was only 44 days to find a bottom of 32%. Now, what is a bottom really? A bottom is a point at which if you had bought, you would have made 20% from there at some point. That means wherever the bottom was, if it fell from 6,000 to 5,000, 6,000 to 4,000. From 4,000, if you had bought it, it would have gone to 4,800. And that 4,800 is a 20% gain for you. That's all I'm asking about. So if anybody is buying today, they're saying, listen, the market's going to recover 20% from here. The answer to that question really is that we've had about 60 days from the time we made a top. That was all-time high to now. In these 60 days, we have fallen roughly 20%. And in that 20%, is this a bottom? So the median number of days to find a bottom, a 20% fall in the last 20 years has been 118 days. Average a little bit higher, but let's take the median of 118 days. That's roughly twice the amount of time if it's taken now. That means if we were to be an average correction, we would have to spend another 60 days sitting here waiting to find the bottom. And even then, the recovery would still be another 30 or 40 days away. But assuming that you could find a bottom, I think you would be able to establish that you found a bottom only in about 120 days roughly. So given that, I think, waiting for another 2 months or 2.5 months, I'm talking calendar, not trading days. So in effect, you should wait another 60 days for finding a bottom. But also quite clearly looking at the subjective angle of things. Is Corona done with? No. We haven't yet seen panic hit the streets. We just assume that Corona becomes a big thing in India. It will. I mean, it's not about, like you've said, Shrey, it's not about if, it's about when. The problem that we are trying to solve right now is not that the coronavirus will come to India. It's just that we don't want to overwhelm the medical system by having all the cases hit us at once. That's why we're shutting down so that people can not have to congregate, and therefore there will be one-odd cases. They will slowly rise, and then they will be able to be controlled over time. That means that everybody in India in some way or the other is going to get impacted at some point. The question is about when. Today, we are at a relatively early spread situation, which means we have less than 100 cases. We probably have 5,000 cases. Okay, we just haven't tested for them. Remember that comorbidity, which is basically saying older people get impacted a lot more, and older people who do get impacted actually have other conditions like diabetes, like heart disease, and so on. There is a potential that when they get impacted, people don't think it's the coronavirus. They think it's one of the other factors. So there is actually a lower diagnosis of the disease. So the impact right now is probably not even known. So once it starts growing is when we'll see how bad the spread is. The economic and social impact of it is still minor. You have seen restaurants shut down. You haven't seen businesses have to completely shut shop because they can't afford to pay their rent or their salaries anymore. That's also going to happen at some stage because we're going to we hope that the current shutdowns and lockdowns are only for a week each. That's all you need actually to help the spread slow down. More people to work from home, and because at some point life has to get back to normal, and given the way this disease spreads, as long as we can get enough people inured from the virus, so that the people who are affected are lesser in number, that will come across. And so, I mean, you'll be able to control the spread of the disease. So I think where we are right now is the early part of the crisis. We haven't seen onset, we haven't seen numbers. We should actually be happy to start seeing numbers like 5,000 and 10,000 in India, because for a country of the size of India, 5 or 10,000 is nothing. So, and remember, of course, these are affected cases. The number of people who actually die from it may be a substantially smaller quantity as well. So, until those numbers come, think of it as padaos, or levels. The first level will be when it starts to affect all the major cities, when the numbers start to hit 1,000, 2,000. The second level will be where it starts to hit 10,000 and 15,000. It will probably start turning back only when it crosses 25. But we'll be able to know whether the numbers are still growing exponentially or slowing down. At the slowing down part is when there is a recovery. Put another way, how many of us actually know someone who's got the coronavirus? None of us probably do, and I don't know anybody. We've not heard of anybody, even in the Slack group that we have, of people who've actually got it. We don't. Once we find that one person, I know the name, I've seen this person, I've met him at some time in my life, and that person has got the coronavirus. That's level 1. Level 2 will be somebody who's like literally next door to you. So it's like probably like in your neighborhood, in your school, in your office, that you know personally, and therefore you could have at some point in the last few days been in contact with this person and potentially gotten it. That's level 2. And third is when literally you've had some kind of a direct impact on it, maybe within your direct family and so on. So these are the 3 layers at which we should expect these to happen. Now, all of these will happen over time. If it happens over the next 3 months, saying 1 month later I hear of somebody, 2 months later somebody in my neighborhood gets it, 3 months later I might get some small symptoms of it, then it's okay. But if all these happen within the period of 1 week, then the spread is substantial. So you have a much more a spread out disease. So I think the crisis is not over. Yes Bank situation may have been resolved to a certain extent. You've got a situation where they've announced a moratorium will be removed on Wednesday. And so hopefully that will be behind us. We'll see how that evolves as well. Hopefully that does not result in a more bank-related panic. But the rest of it, I think there's still a lot of time to come. And therefore, if you think of a person saying this is the time to buy, I'm saying this may not be the only time to buy. This is a good time, but there will be equivalent times or worse. Another way to look at things is the Nifty price to earnings ratio, a historic price to earnings ratio, an indicator? If it's right now, it's about 90, which is average. Roughly decent amount of time is spent here. This is the average time to buy, and it's not a great time to say, listen, sell everything and just buy equities. If the Nifty P were to fall to 14, it would be a fantastic time to buy.
But what does that mean? I mean, that would what levels would that correspond to?
That would correspond currently, because given the Nifty earnings right now, it corresponds to roughly around 7,500. Give or take a little bit of earnings growth, you're talking about 8,000 levels. Okay, and so it's not too far away where you would say, oh, this is a great time to buy. But right now, I'd say best thing, buy, but buy in chunks over a period of a year. And when it reaches those points where it's so juicy that you can't stop buying, I think that is a time when you can say, listen, I'll put a little bit more money in.
All right. Well, one thing which does strike me as different, however, this time is when it comes to the 2008 crisis that we've now heard of incessantly, or the other sovereign debt crises or other crises we had, they were all in some senses financial or in some cases market crises, which then had painful real world impacts. Here it seems to be the other way around. We've started with very painful real-world impacts, things slowing down, economic activity truly having slowed down or stopped in some cases altogether. And that in turn is justifiably, I guess, spooking the stock market and other financial institutions. So since we haven't seen one of these in a while, maybe 9/11 was the last one that, we've heard of in that sense. How is this kind of a crisis different?
The issue with financial crisis, the financial market-led crisis, is what they do is they freeze the markets. They freeze liquidity. So as a business, I want working capital, I'm not getting it. this can be solved financially, right? So somebody can say, listen, I'll inject capital and I'll make sure people lend to you. So you then can continue your work. You may see a drop in aggregate demand, but over time that can be solved by using purely measures of liquidity and financial, addition of financial capital. But one of the things that happens in a real world crisis is, and this might be actually quite optimistic as well, is that it tends to be formed out of less leverage rather than more, which means people are actually seeing a lack of both supply and demand. So I want masks, I don't have them because the people who produce them can't get them to me, because people on the ports aren't working, and so on and so on. That's a supply side problem. There's a demand side problem as well. If I have to stay at home, I'm not going to go anywhere, and therefore there's no demand for oil or petrol or crude or restaurants or pubs, or therefore electricity and so on. So there's a lot of demand side pressures also that go down. Now both of these have problems because they can affect everything, and the financial economy is obviously scared because if I give you working capital today, you can't do anything with it because you don't have people coming to work at your factory. So when this crisis goes away, there's going to be that problem. What's going to happen right now is people are looking there and saying, listen, I need a lifeline. I need to be able to pay my workers, because if I don't pay them, they will never come back. I'll never be able to restart my factory. But if I pay them and they have not got any work done from them during the time I've paid them, I will go out of business. So you need to be able to either give me a loan or give me a grant or give me a time off. So there are landlords in the US who are saying, listen, if you can't pay rent because of the coronavirus, I will not charge it to you. So I'll give you a month free. This is stuff that we have to do. But also with technology, a lot of the things that the time compression, there's been a time compression of recovery. So if you look at where we are today and where we were in 2000 and 2001, if you got a similar crisis around at that time, just getting people together would have been a lot more difficult without, let's say, tools like WhatsApp and Twitter, which are so ubiquitous now that you could form subgroups, you could form groups. I'll give you one example in bank. I mean, China is much more matured and they track every citizen, right?
On the flip side, you wouldn't have panicked this badly.
Yeah, I mean, it does add to both layers. So you get panic at some level. You get WhatsApp education from a university that tells you, drink a lot of water, by which time I will drink some water just because WhatsApp university told me that. But
does drinking alcohol help?
Well, it helps a lot of things, I guess. But I would so that's the one thing I liked about the WhatsApp message, was that if you have alcohol, it's going to kill something in your throat, and well, it's always good to have justification. Let's see after a while if it's medically confirmed. But the interesting thing about this is that both, while it helps the panic expand the panic at one layer, it will also help in efforts to reconstruct the economy. Today, a lot of people in cities live alone and they're above 60 years old. We all know that people who are above 60 are at maximum impact from the crisis. Can we as a citizenry today, I'm talking about today versus 2000, we'll say, listen, let's kind of try and help people who are above 60 living on their own in localities around us. If I had to do this in 2000, I would literally have to start calling people on the phone and saying, in your locality, please do this, and try to coordinate all of these things. And at maximum, my effort would be local. At some small level, I might be able to get some kind of, website up and so on. That it would take a lot of time. Today, you could do this on WhatsApp very, very fast. So the reconstructive effort after this is over, after the corona situation is under control, can be relatively much faster today with the advent of technology. And perhaps some of those technology companies will actually benefit a lot from being able to coordinate this crisis as well. This also means that a real Main Street crisis versus a Wall Street crisis has multiple layers of solutions, some of which can be fiscal, some of which can be community based, some of which will require to be financial. So it doesn't necessarily need only a financial argument. a financial source of help. But we do need the finances as well, because if I need to refinance my loan and you're going to increase rates for me, then I'm going to shut down my business. I need lower rates. India has extremely high rates. All the other countries seem to have recognized already that rates are too high. We cannot keep high rates. So therefore, they've cut their rates or eased their economy substantially. India hasn't yet. I think it will. And in this process, I think both the community efforts will also help, and also fiscal measures, perhaps from the government, perhaps from other places, will come into play as well. So it's different, but I think from a recovery standpoint, I'm quite optimistic that it will not take as long as a financial system based recovery.
All right. Well, let's move back to financial markets then for a second, and confront the question that we've been getting for the last few days. How do we play this financially to that extent, and how do we invest now? So let's think of two scenarios. The first one, where you've been fortunate enough that for some reason you have cash lying around, or you have a lot more debt than you wanted to, or than perhaps you need, and now you're going to use, debt funds for that matter, and now you have the ability that if you so wanted, you can deploy funds into investments. How would you advise that person to invest?
So this is interesting because there are two kinds of people who end up having too much or a lot of cash. One is a person who's actually quite risk averse. Your choices as a risk averse investor will not be to go to equity, but you would want to avoid a crisis in the debt markets. So a debt market crisis can come from corporates not being able to pay down their debt. So you want to reduce the amount of corporate influence and hope that perhaps PSUs or banks will be better able to pay. We've not had a bank failure in India. I don't think we're going to get one. So we even Yes Bank, for instance, fully protected all deposits and most bondholders. So if you were to buy funds, I would say look at government securities based funds that are perhaps shorter term. There are very few of those, but you could use those as a metric. Or if you don't mind investing for the longer term and you believe, like we do, that interest rates are going to come down, not go up from here, then government security gilt funds that are 5 to 10 years in nature, in duration, and you've got PSU and banking debt funds. At the other extreme, you have overnight and liquid funds. So those markets tend to be reasonably secure. I'm not saying they're going to be totally safe. And of course, there are fixed deposits with banks, and there are fixed deposits with government institutions like post office deposits and so on. These are also avenues that you could look at if you were to think of yourself as not as risk averse, saying, okay, listen, I'm risk averse, but I can do with a 50-50 allocation, and you aren't at 50-50. You're at like maybe 90-10 or something, just because you've been scared of the debt market so far. Then take the remaining out of the debt markets over a period of time and invest, say, over the next year rather than just over now. Because if you are to time things, then SIP wise is a great time to start, because you're starting at a valuation that's much lower than, say, 2 months ago. In fact, much lower than probably, till 2017. Today, you're getting prices of 2017. Yesterday morning, at the time when the market was a lower circuit, you were getting prices of 2014. So you get 6 years of economic growth without really any...
having to pay for it.
Without having to pay for it. Yeah. So that's effectively how you can think about it. And if you're saying 2017 prices to now, we're getting 3 years of economic growth. It's not been great economic growth, but it's still better than anything else. But you also know in your mind that this could possibly get worse. Do an SIP. It doesn't matter. It's just so much easier in your mind to say, I'll start now and add more later. Psychologically, it adds to the behavior that says if it goes down, you can invest a little bit more and still have a substantial amount of your money in debt.
SIP into what, Deepak? We did a
good
webinar
question.
yesterday with our premium customers, and where you showed how bad SIP returns have been on Nifty.
Yes, it has been bad, but that does also means that equities which are volatile tend to create pockets at which today the returns have been low. But if you looked at it 2 months ago, the returns were superior. That means when the Nifty starts to make all-time highs, your returns look reasonable. But if you look at lows like yesterday, the returns are low, which also means that if the equity market is to perform equivalent to the underlying economy itself, the nominal rate of return that the economy gives you, it's more likely that the stock markets will also give you that much. And if you look at about, say, 6% inflation, 6% economic growth, 4 or 5% inflation, 10 to 11% a year is what your returns should give you. From 2010 to now, 11% returns would have meant really that the index should have been at 13,000 or 14,000. If it hasn't been for 13,000 or 14,000, you are lagging behind the economic growth that the country has given you in the first place by nearly 35 or 40%. In a way, this is a bullish case because just a reversion to mean, and I'm saying mean, just give me economic return. Don't give me any premium on that. Just give me economic return and you should get about 30 to 40% from here, but it won't come immediately. It may come over the next 5 years, not immediately. And it may not be 35, 40. It may add the economic growth of the next 4 or 5 years as well. So what happens because of the underperformance of an index over a very long term is that you get outperformance if that is the point at which you start investing. One of the fundamental problems that I've also had has been that we've never had earnings growth in any meaningful way come into the index for the last 4 or 5 years. So we were paying a lot, but there was no growth coming from the economic engine itself. The earnings wasn't moving. For the first time, the last 6 months has seen economic growth in the index itself. Of course, the next 2 months are going to be horrible. Okay, we know that. But the next 2 months also sets up a base that the next 2 quarters are going to be horrible, but the next subsequent 2 quarters after that is going to see a mean reversion as well. If you don't watch movies for 2 months because theaters are closed, all the movies that are in line to be released will release after those 2 months or 3 months, which means that you will start going to movies like you'll go to 4 movies rather than the one that you were seeing a month, simply because those releases are blockbuster and you want to see them, and the corona is behind you. So in a way, the economic activity is also going to be bunched after 2 quarters. So expect earnings also to be bunched around those 2 quarters afterwards. So look 1 year ahead. Earnings are going to be bad for the next 2 quarters. Earnings are going to be decent for the subsequent 2 quarters. So it will balance out from an earnings perspective. If earnings growth continues to remain, I think then that you're getting an economic engine at a fair cost. I'm not saying very good cost right now, fair value today. It might get to a point where it's really you're buying 1 rupee of economic growth for 50 paisa. I hope that doesn't happen because it means a rapid destruction of the market from here. But if that happens, then it really becomes much more cheap. From an investing standpoint, I think what's important to do is to say that, okay, where it's fair, I want to also invest fair, which means my SIPs go much more easily from here. If I'm cheap is when I'll say, forget everything, I'll take the next 6 months SIP and bunch it and putting it today. That is more like an investment plan for a crisis rather than just to say, Deepak, should I just put everything today? And my answer to that will almost always be no, unless the market is so cheap, it's like shooting ducks in a row. This is a little bit too much Buffett, and I don't want to quote Buffett too much because everybody does.
Well, let's push for names. I mean, if you're looking at where to put your equity exposure now, would you look at, I don't know, would you look at large caps? Would you just do index funds? Where would you go? I mean,
so the large cap mechanism is this: all of the big money comes into the large caps, and we've seen FIIs take out money. They're getting a $1.5 trillion QE in the US. That's 100 lakh crores. Assume 0.5% of that trickles somehow to India. And the last few QEs it has. That's 50,000 crores. That's more money than all of these guys have taken out in the last 10 months. And they've caused a 25% drop in the market. Assume they caused another 20% drop in the market. They would have still taken out only 50 or 60,000 crores. And that money is going to come back just through the trickling down of QE. Where's that money going to go? It's not going to go into the small and mid caps. Most likely to the large. And look also at Indian behavior. We're looking at upping our SIPs in mutual funds. Mutual funds will buy large caps. Because if you put 18,000 crore into a small cap fund, he has no small caps to buy. I mean, if you consider 18,000 crores in a mid and small cap fund, every investment of his has to be 180 crores. If each investment of it is about 5% of the fund, he has to invest in companies that are worth about 9,000 crores. 9,000 crores is like there are maybe about 70 companies of any investable nature of that kind. 70 companies is not enough for a mid cap fund because he needs 100 just to be able to make his grade. So I don't think that the money will go to small and mid caps. All of the new money that comes in will start going through large caps and then trickle down. So maybe better to invest in large, which means effectively the Nifty, because Nifty, Next 50, a NASDAQ 100. The guys who make money in this downturn are going to be the likes of Zoom, Amazon. I don't want to go to a shop because I'm afraid to get this thing. I'll order on Amazon. I'll do work from home. It'll be Zoom. It'll be Microsoft Teams. It'll be, or I'll use my Android phone with Skype on it. All of these are products owned by listed companies in the US. So you want a combination perhaps of we have this in Capital Mind Wealth. Just to plug our wealth management service here as well. We do this consistently. We have a 33% allocation to the NASDAQ 100 and 67% allocation to the Indian top 100 in a way. And this actually becomes a very simple way for you to invest without having to think about which stocks to buy. I don't know whether HDFC Bank will be the leader of the next movement. I don't know if Reliance is going to be the leader of the next movement. All I want is the top 100. Whoever is the top, just give me the top. If in 5 years the top has changed, I don't want to have to make those decisions. You make them for me. That is done by buying just ETFs, and you always remain in the top 100. The reason I say ETFs versus or index funds in this case, because ETFs are not necessary in India. You could do index funds, and most of these index funds, the combination of an index fund between India and the US has done better than roughly 85% of the large cap oriented mutual funds in India over a long period of time. So unless you're a stock picker, you should just choose a passive way to invest.
Okay. Well, that covered one scenario. Now let's look at the person, which is like, I guess, like more of us, who already was substantially invested and has unfortunately now seen sharp losses and isn't feeling too hot. What should they do?
So two things about losses. First thing is that you start feeling risk averse. You're going to feel like I should have taken less risk when you start seeing losses. There is this theory called an uncle point, which I think was by one of Jack Schwager's books by Ed Seykota.
As long as it wasn't Warren Buffett, it's fine. Yeah.
yes, it isn't Warren Buffett. But this guy talked about the uncle point at which you will start calling your uncle for help. So that is the point at which you have to start realizing what is that point for you. If you've invested 90% of your money in the stock market and you lose 35%, now you're going to be feeling absolutely miserable. So this is the point at which you're going to start saying, listen, this is my uncle point, I can't do any more. So if you haven't reached that point yet, then it may still be time to stay put, but not to add more because your concentration in equities is still fairly high. If you feel that your concentration in equities is relatively low, then you could still build up starting now towards the next year, simply because the if-when sequences haven't yet happened. You still haven't found out if other people have got the coronavirus that are close to you. You haven't found out if the market hasn't come to a point where it is ridiculously cheap. None of these events have actually happened that prompt you to say that the current crisis is possibly over. Until that time happens, putting in a lot more money at one time is a bad idea. So for the people who have taken losses till now, losses which have been taken have already been taken. If you're feeling really miserable about them, yes, take out some money and put it aside into debt funds. If you're not heavily already allocated to equities, that means your debt equity allocation would have fallen. If it was 75-25, right now it will be 70-30. If it has fallen to a point where you can add more and still be comfortable, I think that's the time to start saying, I will add that more, but over the next 6 months. It's a very boring thing, I suggest, because, the most thing that people want to hear is, this is the time, go and buy everything that's available and buy HDFC Bank and buy Reliance and buy. But unfortunately, that is not the right answer at this point. And I think at least in my view, the issue really is that you want to make decisions, but at this point, you should not want to make decisions. You should want to figure out when you need to make the real decisions. Right now is the time to sit back and say, listen, if this happens, I am going to put in more money. If that happens, I'm going to take out money. If this happens, if all those, if you start making the decisions on what to buy right now, you will end up feeling miserable. And the other point is, there's this Zen thing, right? So you have to put yourself a little bit away. The more you talk to people who are making decisions for themselves, the more you panic internally. If somebody is buying groceries today, you're like, hey, I should buy groceries. If somebody's saying, I've got 3 months of toilet paper, and you're thinking, you don't even use toilet paper, but you're going to buy 3 months of toilet paper. But the problem really is people take decisions sometimes simply because they feel the necessity to take that decision now rather than delay that decision later for later. So it may be time for you to start thinking about the fact that looking at your portfolio a little bit lesser, trying to make decisions a little bit slower than they are, will actually help you go through panic. It's your own coronavirus in your brain, right? It's causing panic, and you have to shut things down before you start making decisions.
All right. Well, let's run with that. You've been through various financial crises before. I believe you're running an algo fund at one point of time during one of the crises. So what if you do nothing and you only react after this whole thing is over and the markets are already up 20%, so you didn't get the bottom, and now every time you go to a party in the post-corona world, everyone tells you how they traded brilliantly and are now up 2x or whatever. Other than the social shame of missing out, what's your advice in general about trying to figure out the bottom and whether that's realistically possible?
So yeah, the biggest fear, of course, is missing the first 20. I caught the bottom versus I caught it 20% higher. Now let me give you the example. It's a very bad example perhaps, but it's me. I was sitting in October 27, 2008 in Delhi in my in-laws' house, and I was trading the markets at the time. The market had fallen. Now remember, it was at 6,000 in January. By July, August, it was at 4,000. And by October 26th, it was at 2,800. On, to a little bit less than 2,800. On that specific day, it had fallen for a few minutes to 2,200. I had gone long at 4,000. Remember, at 6,000 to 4,000 is a 33% fall. It's more fall than we have seen so far. I had said, if its market has fallen 33%, there can be no more. Then I saw it fall another 25% all the way to 2,800. And I was like, fine, I'm fine here, right? I could put more money here and I'm fine. The market then slipped to 2,200 for a few minutes. This is 600 points, another 20% further down. I don't know anyone who would have the mindset at that time to say, sell everything, sell whatever else you have and buy stocks like crazy at 2,200. Today it sounds very easy, right? But at that time, it was absolute pandemonium, panic in the markets. I couldn't press the F1 button, which is the button you need to press to buy on that terminal. I just couldn't do it. And I don't know many people, obviously some people have, almost by definition. The market recovered from there. Okay, where did it go to? It went to 2,800. Okay, so if you had bought at 2,200 and you were where you are today, in about 12 years, you would have got 4x your money. So if I had put in even 1 lakh rupees, then I'd had about 4 lakh rupees. That would have made me happy. But let's say, forget that. I missed the first 20%. It went back to 2,800 to 3,000. I missed the first, 2,200 to 3,000 is nearly 35%. But I missed the first 35% of the recovery. I would have still made 3.3x my money. My 1 lakh would have become 3,30,000 rupees. Still nothing to scoff about. I would still be fine. Let's say I missed another few months. I didn't even do anything because the first recovery happened in 4 days, right? So even if I didn't do anything and I waited for the last intermediate high to be taken out, that happened in, I think, March 2009 or so. If I waited till then and then bought, I would have bought at 3,200, which means my 1 lakh would have become 3 lakhs. It's still meaningful and it's still okay for me to do it. So if you if you miss the first 10 or 20%, it's not going to kill you. You may not have bragging rights, and perhaps all of us don't need bragging rights. But if you do this SIP mode, one of your investments will be close to the bottom. So you can always use that as bragging rights and say, I invested at the bottom. You don't need to tell people that, that was only about 1% of the total amount I invested. So you'll still have the bragging rights because you can use the contract note to say, ye dekho, I had this. So you get bragging rights if you do the SIP mode, but you also cannot time the bottom. And I think for all the stuff I'm talking about, the coronavirus, I may be completely kidding myself, and there may be no impact. There may be a vaccine found tomorrow and markets will go straight upwards from here. In which case also, because you did an SIP, you would have had one SIP like on Monday. And that would still be closer to the bottom than if the markets went straight up from there. So in one way, the issue is you can't find the bottom. If you're a gifted stock picker that probably isn't listening to this show in the first place, but most gifted stock pickers also can't find every single bottom. So at some point, it just makes sense to say, do it in a meaningful way, and don't worry about missing the first one. In fact, sometimes the market gives you better returns if you invest after you have missed the first 20%. So if a market has to go from 1,000 to 3,000, does it matter if you get in at 1,000 or 1,200? Answer is maybe not. It's not a meaningful difference. In 10 years, a 20% return on the market, okay, a 15% return on the market would give you roughly 4x of your money. So your 1,000 will become 1,400. If you got in, 1,000 will become 4,000. Yes. Whether you got in at 1,000 or you got in at 1,400 will make no meaningful difference for you. In fact, you probably have more confidence at 1,000 when the stock has moved from 1,000 to 1,400 than when it is languishing at 1,000. So you'll put more money in at 1,400 than you will at 1,000. So you are quite likely to have made more absolute money after the stock hits its 10-year numbers. And I'm talking of a stock that only increases 15% a year. And I say only because on Twitter, you can find people who make 15% every day, right? So it's almost like saying if you're gifted, you still can miss the first 40% and you still be okay.
Fair enough. I think on that, I think we can call it a day. So everyone, let's stay safe, and hopefully the next one we're doing doesn't have to be on Zoom. And see you next time. Thanks, everyone.
Thanks, everyone. Wash your hands, be kind to your family, and hope all of you are safe.